Guest speaker, Jeff Parks, the Finance Officer of DJ Simmons on behalf of New Mexico Highlands University and the Oil and Gas Company Financial Analysis course specifically. And we're going to learn a little bit today about Jeff and DJ Simmons and some more about what the role of accounting looks like in an independent oil and gas company. So welcome students, and we'll get started right away here. So advancing the next slide here. Jeff, welcome. Tell me a little bit about yourself. Let me ask a few questions about yourself, okay?
Sure, and it's a pleasure to be here, Chris.
Jeff, you've been doing accounting and finance for quite a while, but you're originally from New York. You live here in Farmington, been here a while. Have you always worked in the oil and gas industry? You've done a few other things here and there.
Well, I've been in oil and gas about 15 years. Prior to that, I was actually in the airline industry, and before that in public accounting, where I got my start. But I've been in oil and gas about 15 years, all of that with DJ Simmons Company. DJ Simmons is a small, independent exploration and production company. We're headquartered right here in Farmington. Our production is all within a short, well, within a hour drive.
Yeah, short's relative out here in the Big West.
An hour drive to Farmington in the states of New Mexico, Colorado, and Utah.
Okay.
We operate about 70 wells or so. We're a family-held business. We've been doing business since the 1950s, and we're presently on our second and third generation of oil.
Wow. Okay. And so privately held, mostly natural gas is production, right?
Yes, about 85% of our production is natural gas value.
And I noticed there's a website there on the screen, so students can punch in and learn more about the company. But
yeah, we've got a website with some information there about the company and our projects.
And clearly, those who live in the San Juan Basin know the name DJ Simmons and know the company is a long-time, good quality company, fair and ethical. In fact, speaking of quality, did you guys earn some quality awards not too long ago?
Well, we did earn Roadrunner recognition from Quality New Mexico several years ago for going through part of their quality process, quality improvement application.
So even though you're a small company, you're still very much focused on quality processes and being a good, efficient steward of shareholder dollars and labor time and everything else, it sounds like that.
Well, a small company has some advantages and some disadvantages versus a large company. One of the things that you have to be particularly good at when you're a small company is being efficient. And so looking at your processes is very important. It may be, you have some luxuries you don't in a larger company, but it's very important to us to have good processes, good reporting mechanisms, and some of the other things that are involved in the Malcolm Baldwin criteria.
Well, I put a plug in for that because I know a number of our students are actually interested in quality processes. We've talked some about that. So I'm going to encourage everybody to go over to the website and learn more about DJ Simmons. Jeff is the Chief Financial Officer, also the Chief Accounting Officer, and we're going to talk a little bit today about both finance and accounting. So let's move right along into that. And I've got some discussion topics, Jeff, you and I have talked about. I'd like to kind of walk us through these questions, and we'll pick and choose and kind of work our way through those for the benefit of our students. So as the Chief Financial Officer and Accounting Officer, what are some of your key responsibilities? Who is your boss, and what does he think you're responsible for? Maybe that's a good way of asking it.
Well, as Finance Officer, I report to the President, who's also who's on the board. In a bigger company, my job might be titled CFO. And at Simmons, and I think this would be common in many smaller oil and gas companies, I have several responsibilities. First of all, I oversee the accounting processes, paying the bills, getting revenue in from the product that we sell, putting together financial statements, and that really is what I would consider my first important responsibility and the first important responsibility of an accounting department.
And you're actually a CPA as well,
yes,
right?
Okay. I'm a CPA.
Okay.
Putting together financials in a way that they are meaningful to a manager so that they can make the best decisions that they can for our company. The second major set of responsibilities that we have is compliance reporting for state and federal agencies.
Things like we've learned in our class about royalty revenue or royalty tax payments or severance tax payments, some of those sorts of
things. Yeah, that would be one. First one would be for income taxes.
Oh, okay. Yeah, can't forget income tax.
Right, state
okay.
taxing authorities. But you mentioned severance taxes. When you produce oil and gas or any natural resource, in most states there is a severance tax, and we're responsible for calculating that and paying it. The third area you mentioned is in royalty reporting. When you produce from public land, well, anywhere, a company rarely owns the minerals that it's selling. It typically will lease them from somebody else, whether it's a private landowner, a state, or in our case, most of our production is from federal lands. And so you have to pay royalties, a share of your production, to the owner of those resources. And with this process, so that's another major area that we have to do reporting every month.
So do you have on staff some specialists that really focus on that sort of activity?
Right. An oil company will have specialists in reporting. Typically, now being a small company, they wear several hats.
Right.
And they do revenue reporting, disperse revenue to the co-owners, but also calculate share royalty.
So you do accounting. What about this finance stuff? What do you do there?
Well, that's a third hat that I wear, is to make sure that Simmons is adequately capitalized to do the projects that it needs to do. Part of that is evaluating our proper financial structure. How much money do our owners need to contribute? What kind of borrowings do we need? What types of borrowing? What level of borrowing is prudent? There's a maximum, or you're headed for, what you're looking for in borrowing is determining the maximum level of efficiency.
Mm-hmm.
Borrowing nothing is not as efficient as borrowing some, but of course if you borrow too much and get over-levered, you could be headed for disaster. So determining where that tipping point is critical.
And some of these projects are actually kind of expensive, aren't they? I mean, it wouldn't be uncommon to see $1 million well or something like that?
Well, for Simmons, yes. Pretty much any well takes $1 million. Of course, people that are playing in larger shale plays are spending a lot more money than that. We hear numbers of $5 million on up being spent for...
And even though if you might share some risks with somebody, that's still a lot of money, though, that you're responsible for lining up and making sure that the engineering and drilling people in the company are able to have, because you got to pay the bills for the drilling company and the water hauler and everything else, right?
Right.
Okay.
Right. And determining another part of financing is determining at what point you can distribute money back to your owners.
Do you mean they like dividends?
Our owners do.
Okay.
That is different. A lot of smaller E&P companies do not pay dividends, but we do.
Okay.
And then capital budgeting and forecasting is another important component of the finance function.
So you spend time with geologists and engineers and listen to what they want to do in the next year or so and try and be at least a step ahead of them. Is that kind of where?
Right. You will typically look at your production profile. How much of our product are we going to pull out of the ground and sell this year?
Mm-hmm.
And then you'll have targets for how much of that you need to replace, plus hopefully some growth. And you'll speak with engineering and geology. What kind of projects do we have? You give them some guidance also about what kinds of projects you want to be looking for. Are we looking for high risk, high return projects, lower risk? Would we rather have more oil nowadays, more gas?
Okay, so there's a lot of moving parts here. Thinking about your role in both finance and accounting, what kind of big challenges do you have in a small company? You don't have a big staff, for example. I mean, you don't have a department of 40 people doing revenue accounting or anything like that. What are some of the broad challenges that a smaller company has, but also maybe what are some of the benefits of working in a small company?
Well, having to be a jack of all trades is a challenge in a smaller company.
Okay.
You don't have a resident expert on any one thing that you can call in-house.
Okay.
You have to try to maintain a network of people outside the company, maybe at bigger companies that have an expertise in an area.
Okay.
That is one challenge. Staffing is always an issue because everybody's doing 2 or 3 different things, and having enough staff to do things is a challenge. In today's finance world, being a smaller company presents challenges. Banks and money sources like lending lots of money. They find it to be a lot of work lending a little bit of money.
Okay, well, we're going to talk. Yeah, we're going to talk a little bit about that. But there's got to be some fun things in a small company. If you were a student and looking to hire on into the industry, would there be some benefits of working for a small company?
Yeah, I think one of the things is that you do get to work on a lot of different things.
Okay.
You do get, for example, in the accounting department, you do get to talk to geologists and engineers. You may get to go out and see a well being drilled. And in a larger company, you would not get to do that as much because you're more focused on one thing. You'll get a lot better at that thing, and there'll be opportunities to move around and learn different things. So those are, that's kind of a trade-off.
But there's some fun things too.
Definitely.
Well, you know, as we go back and we look at the history of DJ Simmons and we think about what we've read in our textbook, I wanted to ask you if you guys use generally accepted accounting principles, or are you GAAP compliant in terms of your accounting? And have you always been GAAP compliant? And if not, what led you to change?
We do issue a GAAP financial statement now. We don't issue all the GAAP footnotes and disclosures, some of which you probably have been talking about.
But in fact, we're actually looking at the 10Ks of ConocoPhillips and Chevron, and it's interesting. Those are 10, 20, 30 pages long.
Yeah, they're
disclosures.
There's very extensive disclosure. I don't do all of that.
Okay.
Because it's not required. We switched to a GAAP system 5 or 6 years ago. Prior to that, since our founding in the 50s, we had used income tax basis of accounting, and I think you'll find that that's very common in smaller companies. The reason is that they don't have the resources necessarily to keep 2 sets of books, and so they will keep 1 set of books, and the IRS, everybody's got to report to the IRS, so that's the one they pick, and that's what we did for, gosh, long 5 decades almost. We switched because GAAP has some advantages over income tax basis. The one thing is that we can compare ourselves to other oil and gas companies and see how are we doing.
Accepted accounting principles, meaning that others have accepted it as well as a standard.
They're using the same principle. So, for example, you can look at your finding costs. Other companies will calculate it in a similar way, so you can compare it.
Okay.
The second big reason is that income tax basis accounting has some serious limitations when it comes to the matching principle. With income tax basis of accounting, you get to expense all of your intangible drilling costs when you drill a well rather than record them as an asset. For us, that was about 80% of the cost of drilling a well was written off right away, whether or not it succeeded. And so it's a pretty egregious violation of the matching principle. If you take an asset, you write off 80% of your costs, but yet you recover your revenues over a period of a decade or 2.
Right.
And that made reading the financial statements much more difficult, having to explain to the owners every month, well, we drilled a well, we didn't really lose gobs of money, it's just that that's the way tax reporting has you do it. GAAP makes it easier to analyze what actually is really happening with the business. Okay. There's still some big limitations.
So this GAAP reporting is good for the company from comparability, and we talked in our class about benchmarking. The next 2 questions are kind of related to each other, and I think I'll take the second one instead of the first one in just reverse the order here. We've talked in class about some of the generalities of successful efforts or full cost accounting. which is kind of an important determining starting point, if you will, policy-wise within the world of accounting in oil and gas. Do you guys use successful efforts or full cost, and why do you use what it is that you use?
When we converted to GAAP, I made the decision, I recommended to the board, and they accepted it, that we use successful efforts accounting. My thinking was for several reasons. First one is I looked around at some of our peers that were publicly traded, obviously much larger, and it seemed to me that they were going in a direction of successful efforts. I think secondly, I had a concern about full cost being perhaps overly rosy. In a company, in a more established company, the difference between the two is not nearly as substantial as it is with a growing company, because the difference between the two is what you do when you drill a dry hole in a wildcat well, which is a well where you are drilling reserves that are not yet proved. Of course, under successful efforts, you would expense that dry hole under full cost. You would capitalize that in a pool with all of your other costs, all of your other wells in a particular country. A company like Simmons is not drilling a whole lot of wildcat wells. We may drill a few, but we emphasize more development drilling because we're smaller. And when you're drilling a development well and you drill a dry hole, you capitalize it just like you would. You do the same thing under full cost as you do under successful efforts. So thankfully, we weren't drilling a lot of wildcat exploratory dry holes, and so there really wasn't a huge difference for us. And I think you'll find with more established companies, the difference is not as substantial. Where it would be is if you have a small, a startup company or a company that's drilling a lot of wells, then you see a significant difference.
Would you say, Jeff, in your view as an industry accounting professional, that generally successful efforts would be a more conservative approach to accounting?
Yes, it certainly would be, because you would be less likely to have on your books an asset that was money spent for a dry hole.
Well, a lot of our course deals with the whole concept of valuation and looking at a company. If I have a conservative accounting approach, I may come up with a more realistic understanding of what a company's value is. Is that a fair statement versus one that's more aggressive and then having to figure out that it is aggressive and kind of backing off of what the numbers might be suggesting?
Yeah, your reserves would be, your books would be more conservatively stated on successful efforts.
Okay.
Now, still, there likely to be significant differences between what your books show the property is worth and what it really is worth.
Well, and we've talked in class about the difference between market value and fair value, for sure. Which moves us now into the question of lifting costs. So we've made a determination to use successful efforts, and that's how we're looking at wells. And once a well's up and running, the costs of goods sold effectively in this industry are called something like lifting costs. Is that a...
Right.
Okay. Tell me a little bit about what lifting costs are and how operations staff, as you produce accounting records that report what lifting costs are, how do operations staff use the lifting costs to manage the business?
Well, I think you used a good term to describe lifting costs. That is our cost of goods sold. That is something that is a little bit confusing about an oil and gas company, is that your reserves look like a fixed asset. They're described as a fixed asset, but really they're like your inventory. You're selling it. And lifting cost is the cost of getting your product from a mile underground or wherever it is, getting it up to the surface of the ground and getting it to the point where you're selling it. And that's a commonly used industry number to measure how efficient you are in operating the reserves that you've got. We use it, the way we use it is to try to compare different properties if we have, and evaluate whether we have one property that has a much higher lifting cost than another one. Well, why would that be? What might that be? Another reason might be that a property with a high lifting cost is going to have a shorter life than one with a lower lifting cost, so that's something else we keep in mind.
Okay. So without getting into disclosure nitty-gritties, I think as I have been a student of DJ Simmons for a number of years. There have been some wells that have very high lifting costs because they were producing a lot of water or not as much gas as we would like, or oil. Is that kind of uncovered as a result of you and the accounting statements looking at the lifting costs and comparing how much you're spending at that particular well to, say, another well that might not have as high a lifting cost but producing more gas or more oil? Is that a way you might be studying lifting costs?
Yes, you look at the big picture, what is my lifting cost on this well, and it's generally measured in dollars per whatever your major product is. Say if you're a primarily gas producer like we are, you'd measure your lifting cost in dollars per MCF produced. 1,000
cubic feet of gas
right.
produced, okay.
Or if you're an oil producer primarily, you'd measure it in barrels.
Okay.
And so you would look at that number, and if you have a lifting cost, it's $20 a barrel on one well, and it's normally $10 a barrel. Then you could dig deeper and say, well, yeah, this well produces a lot of oil, or I'm sorry, a lot of water, or it's got it's behind a bad gas plant that charges a whole lot more to process gas, or it's very remote.
We've talked in this class about the importance of this. I'd be interested in your thoughts on it to see if you agree. You can't control what you sell your commodity for price-wise generally. I mean, short-term you may have a hedge here or there, but over time you don't really control what you sell the product for, right, in terms of price?
Right.
So is it true then that managing lifting costs is really the key lever to the profitability of the business in terms of cash flow and earnings by managing that number and paying attention to that?
Right, and that's a little bit different than a lot of other businesses. We cannot control the price for our product. What we can control is how much we produce. So as a commodity volume, you will produce as much as you possibly can, which is not the case for a lot of companies. And the other thing is you say you can produce you can control are your costs, your lifting costs being a big one, and then finding costs being another.
So an oil and gas company would, like other commodity producers, would be very focused on expense control.
Right, expense control and production increase.
Production increase.
So those are key, and lifting cost is really one of the foundational key performance indicators we look at.
All right. Next question that I wanted to touch base on is we talked about the having reserves. How do you calculate the value of reserves on your books? You mentioned you got somewhere in the neighborhood of 60, 70, 80 wells, whatever it is, and there's gas or oil underneath the ground in the formations that you have, and you've got some theoretical quantity. How do you know what to tell the shareholders exists there in terms of a balance sheet of total volume amount of commodity, but then how do you fix a dollar value to that commodity? It's unproduced. I mean, it's on the shelf, as you said earlier, maybe. But what do you guys do at DJ Simmons to figure out what the value of reserves are?
Well, on our books, things are, because of the cost principle of accounting, things are put on the books for the cash that we shell out to get them, which I think, as you'd mentioned, you talked about in class, doesn't necessarily bear any relation to what they're worth. But on the books, they're based on what we paid to get them minus any impairments we've had to take.
So you would say that the book value, just before we move any further, the book value of the reserves of DJ Simmons may be a lot less than the market value of the reserves of DJ Simmons. Is that a fair statement?
That is typically a key area for oil and gas companies, because you're hoping, your goal is to spend an X amount of money but get many multiples that the value of reserves in the ground.
Okay.
And that's frequently not the case in other industries. If you're a trucking company and you go out and buy a truck, what you pay is basically what you get back. That's not the case for oil and gas. If you drill $1 million well, you're hoping you get $5, $8 million of reserves in the ground. And so typically oil and gas companies, the value of the reserves on the books is drastically lower than the value. Now, that's not always the case. Sometimes it goes the other way, and then companies get into having to do write-downs.
Yeah, you had mentioned the word impairment, and we're going to talk about that in a minute. So you have some folks that I'm sure you work with from some time to time that kind of help you almost in an auditing fashion look at geologically what you have. Is that true? And then do they help you kind of shape an idea of what maybe the total unproduced volume of commodity is, and then what do you do next?
Yes, that's what Simmons do, and I think that's what a lot of small companies would do, is they will have either geologists on hand, or they will hire a third-party petroleum engineering firm. They will give them production data on their properties, and then the engineers will predict what the production will be for every property and how long it will produce. And that tells them, all right, what are our recoverable reserves? And then they will apply assumptions about future pricing, future costs, how long is the well going to operate, and that will enable them to estimate how much oil is in the ground that you're going to be able to get out. And that is typically, for Simmons, we have that done by an outside engineering firm. The reasons you might have that done would be for a bank. Typically,
they're interested in collateral value, maybe.
Right, typically, an oil and gas company like Simmons will have our primary debt facility secured by our reserves. They want to know how much oil we've actually got and what's it worth.
And they'd like to hear that from somebody other than you, probably.
Right, they would. Now, a lot of times, larger companies will have internal staff that does that, and then they get into big rooms with the banks.
And have a little tete-a-tete.
Right.
So once we have those things done, if I really kind of wanted to get at an idea of the fair market value, I might want to apply some discounted cash flow analysis to the total revenue stream I could see if we produced out the life of the reserve. Is that a...
Yeah, that's typically part of what the engineer will do. They will project the revenues that you're going to get. They will project the expenses, the severance taxes, and then they discount that all back.
Okay.
And of course, when you do that, your discount rate is a key number because you could be looking at a property that's got a 20-year life. And when you go out that far, as you know, discount rate is a big issue.
Yeah, exactly. And I imagine in the same way you use successful efforts accounting and have shifted to GAAP, you would prefer to use a conservative discount rate in doing that sort of analysis. So I would imagine.
Banks certainly want to use
bank
discount rate.
All right. Let's move on to our next slide here. We've looked in this chapter on accounting about how to look at depletion, which is, kind of the way you track the taking of the commodity off the shelf, if you will, or lifting up out of the ground. You've got a couple different decision points or ways to look. We studied in class that their IRS gives us a choice, as companies. Do you use the cost depletion approach or percentage depletion approach?
Well, for tax purposes, you have to calculate both for every property that you have, and then you can take the one that's better for you.
Okay.
So every year we have to calculate that for both approaches.
So can you switch year to year?
Yes, you can and do. Now, for GAAP purposes, you have to use the cost depletion method.
Okay. So what the shareholders see as reports would be based on cost, but what you may pay as tax, income tax for book purposes, could switch back and forth.
Right, and those two numbers can diverge significantly. A smaller company like Simmons is allowed to use percentage depletion. Percentage depletion is not allowable for larger companies.
Okay.
Any oil and gas company that might be publicly traded, for example, their production is too large to use percentage depletion.
Okay. So that gives us some insight on that perspective. I want to shift gears and talk a little about the finance side of the business, which is also one of your hats, Jeff. And the class is learning about the three components that make up a balance sheet in terms of common stock, preferred stock, and debt. In the case of DJ Simmons, you guys, I believe, obviously have some common stock. You said you were family-owned, so there's common stock for the company. It's not publicly traded stock, but there's equity represented by shares. Is that true?
Yes.
Okay. Do you guys have any preferred stock at the company?
No, we do not.
Okay. So that leaves one other component, and something that I think is probably near and dear to your heart and closely watched, and that's the debt side of the pie chart. Tell me a little bit about how you think about debt, and in fact the whole capitalization ratio or structure between debt and equity. We've learned that debt is the cheapest form of capital for a good company, a well-managed company like DJ Simmons. Why don't you just go all debt and not worry about it? Or how do you think about the cap structure?
Well, that's a good question, and we get asked that question, for example, by our owners sometimes. There's a thought that, well, debt is bad. We should not have debt. But for the reason that you mentioned, a prudent amount of debt helps you make more money than having no debt, because the cost of capital is generally significantly lower than an equity owner will want, and it enables you to buy a lot more assets than you would otherwise be able to buy, and then hopefully your return on those assets is higher than your debt cost.
When you're talking about buying assets using some debt, you may be talking about acquiring mineral leases and drilling a few more wells and generating more cash flow. Is that kind of what you're talking about using money for?
Right, yeah.
Okay.
Acquiring leases or drilling those leases and turning those into cash flow coming back in, which gives you more collateral to borrow more money.
And if I didn't have debt, I'd have to go back to the owners and ask them to pony up themselves, right?
Right, and that can be done, but it's a much slower process, and the owners will find that they make more money if they borrow prudently. Now, as to your question about why don't we go out and borrow 100%, well, a lot of companies try to do that, and it works if you're successful, but what you have is no margin for error should a project or a significant project fail and you spend a lot of somebody else's money and have nothing to show for it, or if commodity prices turn against you, you can end up with a property whose value has dropped significantly in the eyes of a bank for a reason that may be temporary. And so debt is like, I think of it as like fire. Fire helps you get a lot more done, helps you cook a lot more than without having it. You can do a lot of things with it, but it can burn you if you don't control it. And it's always tempting to borrow more money.
But there are things out of control in your industry, like the commodity prices, or like whether or not a big project was successful or not. So it might be true, using your fire example here as an analogy, it also may be true that if you live by the sword, you could potentially die by the sword?
Right, yeah.
Okay. So looking at DJ Simmons, how do you, in terms of that pie chart, what's the comfortable cap structure for you in general?
You know, I would target somewhere between a third of our capital being provided by debt, between a third and maybe a little over half.
Okay.
But Simmons is a little bit more of a conservative company than a lot of others, and I think you'll find others that would go above that level.
But when we talk about a conservative company, you're also a company that's been around for 60-plus years and survived a lot of ups and downs. True,
right.
So sometimes it may not be all bad to look at conservative companies and say they may have some staying power.
Yep.
Okay.
That's our hope.
All right. When we talk about things going up and down, that obviously can affect the values that you have on your books for reserves. You touched on it just briefly before, but the book talks about ceiling tests and other things like that. How do you guys at DJ Simmons deal with, and the classes looked at and is charting out right now what gas prices, for example, have done. We've seen gas prices at $10. We've seen gas prices within 5 years after that at $3.50. So quite a swing. How does DJ Simmons look at the question of impairments or write-downs on the carrying values for your reserves?
Well, we basically follow the requirements of successful efforts accounting, which requires you to evaluate on a property-by-property basis, has something happened that would cause you to believe that that property may not be, that property may not generate cash flows at least equal to what you paid for it and are carrying it on your books. That could be you drilled a dry hole, 3/4 of a mile away. It could be that prices have plummeted and the economics of that prospect require some
higher price.
Higher pricing.
Okay.
It could be that you lost an important lease in the prospect. So when that happens, under successful efforts, what you do is you look at the future discounted cash flows that you're projecting from that property, and that would include revenues and expenses. And if those aren't at least equal to what you paid for it and you're carrying it for, you have to take an impairment. We typically do that. In a small company, you sort of have a feel for which properties may be not
on the bubble, so to speak.
Yeah. So I will look at those, and I will typically look at, I will use the numbers that our third-party engineers give us that we talked about a few minutes ago. I will compare their projection of cash flow. It's undiscounted if you're using successful efforts, which is, it's a different approach under successful efforts than it is versus full cost. The reason being, under successful efforts, you're being a little more conservative, so they give you a little more leeway on the test, on the ceiling test. And if something has to be written down, then we take the hit. And we have done that.
So the company has taken hits from time to time with the properties. Okay.
Yeah.
But from the standpoint of having the shareholder understand kind of really what's going on and value the company fairly, that's the right thing to do, though, wouldn't you say? Yeah,
I think it's conservative.
Okay.
The only time it isn't is that if things change and prices come back up, you can't undo.
Oh, you don't write things up.
You can never, under accounting rules, you can never write things up.
No, you're no fun. You're no fun at all. Write things down, never write things up. Let's shift gears back to the finance area and talk a little bit about lending. The class is learning about debt facilities and lines of credit and other things like that. You've mentioned that debt does play a role in the cap structure for DJ Simmons. You've mentioned the fact that banks like collateral, and they look at your reserves as a way to hold or to access collateral in order to lend money to you. What are you seeing as a smaller company with some of the banking crisis we saw in 2008, 2009? How is borrowing as a producer for a small producer like yourself changed over the last couple of years?
Well, for Simmons, it really, I have not seen a drastic difference. Simmons we're like all smaller companies, we do not have access to the public market. So we cannot issue public debt, and we're obviously not issuing stock. And so I can't speak to those. We primarily finance through equipment-specific financing for equipment, but our major debt is reserves-backed lines of credit, which is very common with oil and gas companies of small, even large.
So it's not like you just go out and borrow a fixed amount. You open up a line of credit, like a revolving charge card, if it were in simple English like that?
Yeah, that actually is exactly what it is.
Okay.
The bank will appraise your reserves, much as our third-party engineer does, but they're, of course, more cautious about.
So they give you even less value for them, right?
Right, they do. They will evaluate what they think your reserves are worth, and they will let you borrow up to that amount, and you can draw it, pay it down, whatever. And it's the advantages are that it's relatively easy to do. It's relatively inexpensive. The rates on that are very competitive, and we've seen that continue. The disadvantage is that they do not give you a very high loan-to-value ratio. Typically, for oil and gas companies, they'll give you, factoring in the fact that they are more pessimistic about the value of your asset, they might give you 40 to 50% of the value of your reserves they might lend you. Whereas when you're financing other things like equipment or inventory, you can typically lever it a whole lot, a lot more.
Yeah, maybe 70%.
Right.
Yeah, okay.
Yeah, with the building, you might lever it 80%.
Oh, yeah, exactly.
So and the reason is that they're nervous because commodity prices are up and down and up and down. We haven't seen a big change in that front. The one difference I have seen is, or two things that are different are, at least for Simmons, they're more interested in covenants which act as triggers if a company is running into problems. What they aim for is these covenants to be kind of warning signals ahead of time. We've had more covenants requested.
So they want more tripwires around their lending.
Yeah, that's a better analogy. And then they're just really skittish about regulators. So they're asking more questions, and they're always seem to be looking over their shoulders.
Okay. When you say regulators, it's about bank regulators?
Bank regulators.
Okay.
Now, Simmons owns some service businesses, and we do a lot of borrowing for equipment, for example, for our service entities. And I have noticed bigger changes there. Banks are really wanting to lend money, but they're afraid to, and so they're selling money hard. Rates are really good, but they're really not very interested. Their hurdles to borrow money are very high.
Okay.
Right now.
All right. Good. So there have definitely been changes, and it pays to be a good credit-worthy company.
Yeah.
I wanted to, as we come down the tail end of our interview, Jeff, talk a little bit about something you mentioned earlier in a very important responsibility you have as an accounting officer about bringing information to life to help management make good, solid decisions. And this is near and dear to my heart because, as you know, I helped with the creation of this dashboard set. And I want to share for the students a little bit of backdrop before we look at this and talk about how you use this tool set, which for a small company, especially with very progressive thinking, big companies have these, but small companies have these too, and we'll talk a little bit about how you use them. But prior to dashboards, if I look at your accounting system and I had say 60 oil and gas wells that I'm managing, didn't you used to produce income statements for each one of those effectively?
Yes, we would. We'd produce a revenue and expense sheet for each well.
That's a lot of information on paper, isn't it?
Well, and financially, we'd run you a 12-month income statement.
So if I printed that out on paper, would I have to load up several reams of paper in the printer to get it all printed out?
Yeah, and it would take you quite a while with a ruler to go through and try to figure out where the trends are.
Well, you sound like a guy who's actually tried to do that before.
We did.
Well, so maybe there's a better way to do this, right?
That's where the dashboards come into play. What we decided was that we needed to, help our managers more quickly peel out trends from financial and operating data and identify key measures and look at how they were tracking over time. And so obviously graphically is a much better way than looking at individual numbers.
Right.
And so that's when we worked with you to put together these dashboards. Now the dashboard is basically, what we do is we take the raw data out of our financial statements, and then we pick certain key measures that we want to measure. And what we did internally is we sat down with with managers and our owners and talked to them ahead of time and said, all right, what do you look at when you're looking at the financials, or what would you like to look at to help you do your job better? And so with that, we put these dashboards together with your help.
So we're moving now from really accounting to analysis. Is that a fair transition?
That's a good way of
okay.
Yeah.
So we've got a dashboard up here that says finance category, production, and pricing. So you you put some things categorically together. Is that kind of how you tackled it?
Yeah, we picked categories of data that we wanted to look at. The most important thing for an oil and gas company that drives everything else is how much product are you selling and how much you're getting for it. So we have a series of charts that present every month what our volumes are that we're selling, what price we're getting, and then for analysis we can show how that drives revenue. And then just to put in a plug for the dashboards, Chris, the way that the dashboard is progresses beyond a mere chart is that they're interactive, and I don't think you can see that here, but they're interactive, and the user can actually click on different elements of these charts and get our commentary. I will write commentary for these every month that things that I would like managers or owners to be aware of.
So true analysis about why something is up or down or a trend.
Exactly.
And this particular screenshot I set up to have no comment because of proprietary reasons, but that commentary would appear in that window in the lower left corner.
That's right.
Okay. So you've got a dashboard, and if we go to the next slide here, I think if we'll touch base on several of the other categories. If the first one was production and pricing, are we kind of moving down on the left-hand side? Are we kind of moving down the income statement of the business?
Yeah, that's a good way of looking at it. These are the major categories of things that we wanted to look at. Our production costs, which is getting the product to market. G&A
there's lifting costs. We saw that.
Got lifting costs in there. We've got our lifting costs per MCFE chart. We've got our G&A, which keeps us, pays our paychecks. And then we go to the bottom of the income statement, what are our earnings, and then our owners are very interested in comparing of our earnings, how much are we distributing that to them, and how much are we keeping to reinvest in the business.
Okay. Then
we slide over the balance sheet, and we pick key measures there that are, the first set of measures are measuring financial stability, the amount of leverage that we have, how that changes over time. The second set of measures deals with cash flow, which is critical in our business, and because of fairly substantial differences between GAAP and cash flow for accruals and depletion calculations and write-downs and things, cash flow can be is typically substantially different than GAAP income is, which is perhaps different from a lot of other industries. So you've got to be carefully watching you've got to be doing cash flow statements and watching those closely. And we look here at the components of cash flow, where's the cash flow coming from, where's it going. And then we picked some non-financial key indicators, things that we wanted to focus on that were key to the success of our business, the amount of acres that we have under lease, the number of wells we have, and then finally our return on assets number, which is the key number that our owners are looking at to decide whether or not we managers are doing a good job.
So the more you teach the company employees and the shareholders about these measures, these metrics, the more informed they are and the better decisions they can make on the basis of fact. Is that
That's exactly the goal. And we, with that in mind, I go over these with all of the senior and mid-level employees every 3 months, and our board gets these every month.
Good.
So most of the employees here, except for the very rank and file, see these numbers every 3 months.
Good. And they connect some of their behaviors day to day on the job with moving the meter.
That's our hope.
All right. Good deal. Jeff, wrapping up here, I would be remiss if I didn't use this opportunity to ask you as a professional in the industry in accounting and finance to think about some advice you'd offer students if they were interested in this career, what to think about. I guess I'll start off with it this way. Would you recommend a career in oil and gas finance and accounting? And if yes, what advice would you give to someone interested in that field?
I would. It's a very interesting field. Not only is it interesting, but you're doing something valuable for society, providing
energy
for
America.
I won't get on my soapbox all the benefits of that.
Yeah.
But you're doing something valuable. You're producing something. It's very interesting. It's an industry that not a whole lot of people go into, and so there are maybe more opportunities than there might be in other industries.
Well, in today's job market, that's not all bad.
Yeah, no, that's not. I think the advice, gosh, now you're making me feel old, Chris, giving advice to people. But I think some advice I would give people entering into this business would be, firstly, try to learn as much as you can about the business. Talk to as many people as you can in an organization. Work on developing relational and interpersonal skills. That's something that when I was a college student, that's some advice I wish I'd been given. Spend a lot of time on your relational and interpersonal skills.
You mean people are part of business and
right.
working
yeah,
with people?
That's a key element. Be somebody that can be absolutely depended on by your boss. That will, over time, will cause you to rise to the top.
And before we leave that, let's talk a little bit about what that looks like for you. You supervise a number of accounting professionals. What does being dependable mean?
Well, in accounting, I mentioned one of my hats is compliance. We've got deadlines. If you miss a deadline, you're in trouble. So you have to make deadlines. If you're given a project, you want to be known as somebody who will take that project, do a good job, and finish it, and not give up or turn it back over to your boss or do a halfway job on it.
What about attention to detail?
In accounting, attention to detail is very important. In finance, it's also important, but you need to also be someone who does not get lost in the details, that is able to use tools like the dashboards to pick out trends, bigger picture things. So attention to details is important. In terms of specific skills, we need people. We use Microsoft Office products in the office, and I think most people do. That's really a skill that is very makes you more marketable if you are good at Excel, if you know how to use Word or some of the other products. PowerPoint, OneNote is something that we're using more and more. So learning something about those products, I think, would make somebody a better first year.
So all things being equal, if you had a candidate who could really demonstrate solid Microsoft Excel competency in an entry-level accounting position, that would be a good thing for you to look at as a determining factor.
Yeah, that is. When we're interviewing, and nobody comes out and says, gosh, I know nothing about it. If we find somebody that says, yeah, I know how to write macros in Excel, and I'm familiar with OneNote, I use it, or I do PowerPoints for my boss in my old job. Those are big pluses.
Well, I'm glad you're mentioning these things because we're working on these same things in class, Jeff, so I appreciate that. Well, with that, Jeff, I just want to thank you for taking some time and visiting with the students of New Mexico Highlands in this Oil and Gas Management Business Administration program. I'm excited to be able to have DJ Simmons profiled as a representative of the smaller oil and gas community. Our textbook is focused on great big companies and massive mega mergers, but I think kind of the heart and soul of New Mexico oil and gas production really begins with the small E&P companies, and a company like Simmons with a 60-year history and, 40 years in the San Juan Basin. It's just good to hear from somebody salt of the earth right here in good old Farmington. Any last words?
Well, it's been a pleasure, Chris, and I know Simmons has a different perspective than a lot of larger companies, and obviously a lot of people will never work in a small company, but even working for a big company, you'll probably run into smaller companies that you're dealing with in joint ventures and things like that, so it can be good to at least understand what some of the issues are that your colleagues are dealing with.
Good deal. All right. Thanks very much, Jeff, for your time.
You're very welcome, Chris. It's been a pleasure.
Okay.